Thank you and welcome everybody. If it rains, we might even get more people in here, but hopefully it holds off for everybody. But yeah, as mentioned, I'm Scott Cations. I'm glad to be here, and just a quick picture on Altus. You may know us from different names like Argus Software, Forbury, or Altus Edwin Hill. So our background's very much in the valuation and fund analytics side, as well as tax. So very excited to be here hosting this panel with a great bunch of speakers. It's very interesting times in the market, and we've got a variety of people here to cover really a 360 perspective on what's going on. We're going to go through a bit of a market review and how companies are navigating their investment and development priorities right now. We're going to double down a little bit on how we're going to unlock some of that value within there, and then as well as start to understand some of the challenges before we go into some predictions of where we're headed in these interesting times. So really, before we get started, I was going to just go across the panel, and if we could maybe start with you, Phil, and go across, but just give us a little bit of an introduction on your role and your company profile to start with.
Sure. Morning, everyone. My name's Phil Scott. I work at Schroders Capital, so that's the private assets part of the wider Schroders Group business. We're a sort of Schroders Capital, 78 billion AUM globally, covering private equity, private debt, and credit alternatives, real estate and infrastructure. Real estate accounts for around sort of 30% of that business, and in the UK, our expertise spans sort of. In the UK, our expertise spans sort of 12 billion of direct and indirect assets managed by a team of 139 real estate professionals across London and Manchester offices. So I guess a bit about me more broadly. So I run the Greater Manchester Pension Fund mandate on behalf of our local government pension scheme client from the Manchester office, where I'm also head of Manchester. We have a team of 10 up there. And I guess more broadly in terms of the mandate that we run, whilst we do run other, other mandates more broadly from the Manchester office and across the UK, the GMPF mandate in particular, it's a balanced portfolio of core real estate. It's about 700 million in capital value. There's 22 assets at the moment, but we are actively looking to, and I'll come on to it, I'm sure, as we go through the discussion, but we are actively looking to reinvest cash of about 150 million at the moment. So a really fantastic time for us to be well capitalised at this point in the market. And I'm sure we'll talk about some of the opportunity that we see sort of coming up.
Excellent. We'll definitely cover that. So Elizabeth, over to you.
Hi everyone, so I'm Elizabeth Oliveira and I'm a Senior Development Manager at Muse. Muse are a mixed-use regeneration organisation. We're part of the Morgan Sindall group of companies. As a Senior Development Manager at Muse, that means that I manage development pipeline in the southern team, along with another cohort of development managers. Muse, national regeneration organisation. We invest and partner with local authorities and public sector organisations traditionally, and other landowners as well, to bring forward large strategic projects of mixed use and scale. About a third split between a third resi, a third commercial, and a third alternative mix of uses. So Muse are a great organisation to work for, and we do really enjoy partnering, and we're out seeking new opportunities with partners at the moment. We've got lots of large-scale projects, some of which I'll talk to during the session. I work on a project in East London, the Canning Town Regeneration Project, which is part of our English Cities Fund portfolio. Again, I'll talk about that during the session too. Really excited to be here and chatting with the panel.
Excellent. Over to you, David.
I am David Scott, Head of UK Investment Research within real estate at Aberdeen. Obviously, Aberdeen being a large global institutional investment manager. We have expertise across equities, fixed income, multi-asset, real estate, infrastructure, those types of areas of the business. I sit within real estate and head up UK Investment Research. The role itself is pretty multifaceted, everything from forecasting markets to making recommendations, calls on sectors, working with the funds on purchasing and selling within the funds and looking at strategies. So we're involved from not only the top-down perspective on calling markets and sectors, but also the bottom-up underwriting process, making sure we're acquiring the correct stock for funds, and making recommendations on where the market's going and what the big trends are going to be driving market performance, essentially.
Excellent. Look forward to coming back to you on some of those things. So, Jill, over to you.
Hi, morning everyone. Can you hear me okay? So my name's Gillian Scarth. I'm in the capital deployment and leasing team at Prologis. So I don't know whether people have heard of Prologis. It always makes me wonder. It's a name that people don't often hear as a business. It's a leading industrial logistics provider. And we actually have 2.5% of the UK's GDP going through our buildings. So that's the size of the UK's defence budget. So a huge provider. Our portfolio in the UK is 6 billion, but we're a global business and the whole portfolio is worth $216 billion. So a big provider, and are in most cities that are up the M1 and around the M25, and we feel it's very much an opportunity to demonstrate that all cities need logistics, and it's a vital part of its infrastructure. So what's my role at Prologis? I'm involved in growing the business by buying sites and looking at opportunities, but also delivering our existing portfolio, so that's through development, and also involved in leasing across the UK, mainly in London and the South East. And it's a very exciting time at the moment because we're looking at high density concepts, multi-level, and AI has a big part to play as well.
Excellent. A few things to unpack there. And then Martin, do you want to finish this off?
Yep. Morning all. Martin Mohammed. So I'm Head of Investment, Disposals and Acquisitions at Places for London. So Places for London was set up in April 22. So we are a wholly owned subsidiary of TfL. Effectively, we transferred in all the commercial real estate assets from TfL into Places. So I have the envious position of writing the investment strategy for a portfolio of huge breadth. So it's about 2 billion in value, but we cover retail, arches, offices, car parks, industrial, resi, and then on top of that we have a really exciting development pipeline. So our ambitions are to start on site 20,000 homes by 2031. We're already well underway, 1,000 homes completed. I think it's just over 3,000 that are under construction at the moment, and a lot of that is through really exciting partnerships that we do with the private sector. So really, we are a business that is about creating those partnerships, unlocking that land. And as I say, I have the fortunate position to try and guide us through an investment strategy to make that happen. So yeah, really looking forward to covering a few of the topics today with this great panel.
Excellent. Thanks, Martin. I think we're just going to grab some chairs for some people at the front. We've got a good crowd here, so feel free to, don't be shy, come down. We're not going to put you on the panel. We may ask you a question later, but it's a no. Yeah, so please, there's another 2 or 3 seats there. Yeah. Excellent. No worries. Yeah. Excellent. So we got another seat down the front for someone. All right. Someone was kind enough to leave one more seat at the front, yeah. Someone was kind enough to leave a note here for everybody to say risk appetite. So that was one of the topics they obviously wanted us to talk about. But I think, David, you mentioned in your sort of introduction was very much around forecasting the market, and it's we're not going to put you on the spot to forecast too easily. But can you give us a little bit of an insight with your research background? What are the major trends right now? What are you forecasting, and really also what are Aberdeen doing to capitalise on that at the moment in your investment strategies?
Yeah, sure. I mean, in terms of markets that we forecast, we market forecasts of over 30 segments within the UK. So that ranges from offices, industrial and logistics, retail, PBSA, build to rent, healthcare, hotels, you name it, we'll cover it and forecast on it. I'm not trying to say we've got the answer for absolutely everything because it's forecasting. There's an element of risk in that as well. But we have a broad coverage, and really the big theme that comes out across all of it is sector specialisation. Mm-hmm. It's something that's coming out very evidently within the UK real estate space. And what I mean by that is carving out specialties in those sectors. So, for example, we're second biggest logistics landlord in Europe. We're 9th largest residential landlord in Europe. We have a large flagship fund called the Aberdeen Pan-European Residential Fund, which is a pan-European residential fund of which we can invest in the UK. And so for us, it's that specialisation piece, carving out your specialties within those sectors. Really, it's a continuation of a theme we've seen for quite a prolonged period of time. I mean, you look back at the start of the MSCI quarterly index in 2001, funds had positions of 40, 45% allocations to retail. That's halved now. 30 odd percent in offices, that's around 20%. The biggest part actually of growth has been residential. It was less than 1% then. It's now about 10. Other commercial is now about 14%, having grown from low single digits. And actually on top of that, you've got industrial and logistics, which has grown substantially in size within investment portfolios. It's now around a third if you look at the benchmark. So it's that trend, ongoing trend, a continuation of it, of specialisation within sectors. And that's not to say diversified portfolios don't have a place. They absolutely do. But we tend to find that clients are looking for the diversified part and sector specialisation within those sectors that I mentioned, particular living, particular logistics. And also we're hearing more about data centres coming through, which is, you know, nascent but growing in the UK when you compare it to other far more established markets like the US, for example.
Yeah. Oh, interesting. Yeah, we're definitely going to cover a bit of this sector specialisation, but maybe before we get there, I was going to throw over to you Phil, from your end, because you're obviously you're in charge of investment and fund management decisions across. I think you mentioned the pension fund there. So, do you agree with some of the things that we're talking about there, and what sort of asset classes are you focused on? Are you specialising or a bit broader?
Yeah, I mean, I think it's definitely fair to say I rely on my colleagues, very similar to David, in their roles in terms of guiding me in terms of how we set our fund strategy statements more generally. But absolutely, you know, the thematic investment approach driven by the secular trends is absolutely critical in terms of what we're doing on a daily basis. I think, you know, my role as a fund manager and as a sort of capital market specialist across our business is to essentially sort of quantify risk and opportunity at any one given time across the portfolio. So actually, just to give a little bit of context to that, just at the peak of the market, we identified an asset in the pension fund. It was a single-let government office building in Whitehall in London. And it was about I can't remember what the valuation was, but it was well over 100 million in terms of lot size, which was about 20% of the fund by value at the time. We identified that. We thought, look, you know, fundamentally there's too much associated downstream risk here. So we actually sold that asset, and we now sit on this sort of about the cash allocation that we were talking about at the start. But it's meant that we're now in a fantastic position to sort of look at the opportunities that have arisen. And I think really what we're focused on in the short term is, you know, when we look to sort of deploy that cash, firstly, it's fair to say we've been very, very disciplined around when we've deployed it. And I think having not deployed it in the last 18, 24 months, I feel relatively confident that I haven't missed out on an opportunity. If anything, I've probably sort of saved myself, you know, a little bit of a challenge having not bought, say, an office that maybe would have been repriced 75 bips post-purchase. So I feel okay about that. But actually, I guess looking ahead, you know, where we really see opportunity is where we fundamentally can buy across sector, but where there is, you know, really sustainable growth opportunities. So where, you know, occupational markets remain on that solid footing, and, you know, we expect to see nominal growth across most segments. So I think, just to give an example of that, you know, you talked about office weightings more generally. Quite fortunately, our office weighting in our portfolio is now sub 2% by comparison to our industrial weighting, which is almost 50%. So I would proactively go and look at offices today, because I think they are now attractively repriced, but only in the right micro locations. And I think that point is critical. And I'm sure it's a point that we'll come on to. You know, I think we're going to talk about sort of value-add initiatives and strategies and whatnot. And I think that, you know, the office sector more generally, there is amazing opportunity there as long as you're buying in the right locations and you're buying the right property fundamentals. And I guess the same applies whether it's industrial. Again, we would look at that. Life sciences, you know, I see great value in long income at the moment. Again, you know, you'd like to think that as interest rates come in, that's, you know, that asset class, that sector will reprice quicker than most others, and therefore, provided, again, you're buying in the right geographies with the right fundamentals and your income is secure enough, then we ought to be able to deliver that sustainable long-term outperformance for our clients.
Yeah, excellent. Well, yeah, I think we'll definitely come back around to the retrofitting and some of the value-added sort of opportunities right now. I was going to cross over maybe to you, Jill, and just with your Prologis investment and development background, what are your major business drivers now, and maybe give us a feel for, you know, where you're looking to grow your investments in the current marketplace.
Okay, yeah. So we're really just responding to the trends in the market. So at the moment, leasing is key for us. We've got a 30 million square feet portfolio. We've had more occupancy than we have had over the last couple of years, because you appreciate after COVID everyone wanted space. We're still in the 90%. Is the mic working? There we are. Maybe I'll lean forward a bit more. Is that better? Yes. Yeah, good. So we're concentrating on leasing. And the trends in leasing is that occupiers are being very much more cautious than they have been in the past. They're obviously waiting to see what happens to the elections and things like that. We've seen e-commerce is now 26.6%. That's a key driver in the industrial sector. And we've seen Amazon tip their toe back into the market and looking for stock for 2026. And they bought a big site in Northampton. And Nike also has been out acquiring a site in Corby. So those occupiers are out there acquiring in the e-commerce. You've also got the groceries sector. A lot of the groceries, Sainsbury's and Tesco's, are looking for new stock or repurposing what they've got already. So they're doing well. The 3PLs are realising that they've got too much supply and have put some of their grey stock on the books. Also, their margins are shrinking. We found in the Midlands the automotive are pressing forward for space. So there's some positive turns on the leasing, but it's just taking longer. However, we do see rental growth. You know, I think that in those prime locations where customers want to be, there is still rental growth because supply is down. So then on sort of trends on sort of land, we're looking to acquire land. I think our strategy has changed a bit more to covered land plays. So buying land with income on. So obviously that always helps having income coming in when you've got carry costs at a higher level. And we're also looking at open storage sites. They're quite interesting at the moment because they leverage themselves with income while you work up planning. And I think that's the other trend, is that, entitlement and all the things that come with planning takes so much longer, so you're holding the land for longer. Mm-hmm. So we are out buying, and we're also busy leasing.
Okay. Yeah, so a big focus on both sides of the spectrum there. So Elizabeth, might bring you into the conversation here a bit more about, we talked a bit about regeneration of assets a little bit, and you're obviously more on regeneration projects and the larger sort of living sector. So yeah, what are you noticing in the asset management of this? Any real a greater focus on dealing with tenants and attention around that? So what sort of strategies are Muse doing, and what are you doing that maybe asset managers in the crowd could sort of learn something off or take home with them?
Yeah, so Muse, we don't tend to hold stock in the long term, but we are engaging, when we're trying to diversify our pipeline, we're engaging with investors and housing associations and RPs and other development partners in terms of strategies for the long-term management of estates, effectively we're placemakers, so we like to generate value in the places that we're creating. Long-term regeneration, it's phased right, so it makes sense that we're managing it appropriately. But I think it's about collaboration and working with each other to learn about best practice. We're not experts at it, as in, we do make mistakes, but we're willing to face into them and learn from them. But there's a real diversity of how different groups are managing at the moment, and it's a bit of a learning curve, certainly for us at the moment.
Yep. All right. Excellent. No, thanks. And Martin, just to bring you into the conversation here a bit. So obviously you talked about a variety of assets there. Where are you seeing? Do you agree with some of the different sectors there and specialisation? And where are you seeing the growing yields and opportunities right now as you're looking at investments across the broader side?
Yeah, thanks. I was worried because David was saying that the broad portfolio was dead. I thought I was going to have to suddenly sort of chop it up, but no, it's very different sides. So I think what I would say about our estate, having come from assets from TfL, and sort of let you in a secret, unsurprisingly, they were all next to transport nodes in London. So I'm blessed with a portfolio of land that has income attached to it, but it's an organic portfolio. So the complexity for us that some of what you're saying certainly resonates. But I think the complexity for us is that it's been underinvested in. It's the first time that it comes under one corporate banner. And now that we are a self-financing company and we've leveraged debt, we have the capital firepower to go and invest in that estate. So where we're looking is around those transport nodes and those regeneration opportunities. So, when you think about Whitechapel, Baker Street, Victoria, these are all stations where we own a significant portfolio around, where we're investing tens of millions to regenerate that. And a big proposition of that is really about curating those spaces. So what we see is, because we can take that long-term view as a custodian of this land, we see the ability to curate those over time, and effectively we expect that value to find its way in the long term. And that value for us is not just simply, the rental, the IRR, the capital value, which obviously is critical to making these decisions, but it's the improvement to the transport network, the improvement to the customer who's, moving through those stations, and equally the types of tenants on our estate. So, we are fortunate, but equally it carries a challenge that 98% of our estate is SMEs. Those are our customers that let our spaces. So we have to really work hard to help them and support them and make sure that we are a social and responsible landlord to enable their businesses to grow. Because I think what we can do quite quickly is forget that the people who inhabit the spaces, the businesses that inhabit the spaces are our lifeblood. They're the ones who pay the rent, who keep us in jobs. And equally, they bring a lot to the city as well. So for us, it's really about taking that estate that we've got and driving that curation and driving that value through those locations.
Yep, excellent. Well, I wanted to move on to a bit more about unlocking the value within your assets that are in that side of things. And I was going to jump maybe back to you, Jill, here. I think you talked a little bit about capital deployment and the leasing side and focusing on the balance between that. So, yes, I guess I was keen to understand a bit more insights into, what are you specifically doing differently right now to capitalize on that, and any specifics around the capital deployment side, the leasing side that people might be interested in right now.
Yeah. So on the leasing side, we're looking at opportunities to increase square footage. Mm-hmm. So in logistics, it's more tricky because you've got your box, but what we're doing now is putting mezzanines within the space. And in some towns that commands full rent, half rent. We're then also putting terraces, trying to get like the West End offices. Put terraces on there to just assist and a choice between a customer choosing our warehouse over another one, and the terrace gives a better well-being for staff. We very much concentrate that at Prologis. We've got our site-wide park life and all amenity space for the workforce on our parks. So that's commanding greater capital value. We're also looking at AI to help us keep the costs down in terms of design work. We've got some special packages that we're using at initial stages to reduce those professional fees down. We're looking at net to gross ratios on sites, trying to get up to the net square footage. But it comes with its challenges at planning and trying to make sure we're the best neighbour. And we obviously take a longer term view, so we design in for the future. But it comes with a challenge, because construction costs, it's first of, costs are what they are, but we're trying to put in as much sustainability as possible. Mm-hmm. We very much are sustainable drivers, so we've got 16 green bonds in the US, and then in the UK we've been doing net carbon zero for the last 15 years, and now we're just trying to reduce that carbon, so that comes at the cost of getting the steel done through electric furnaces, it comes at a higher cost.
Yep. Obviously, ESG is a big topic around right now. So, maybe over to you David, from your end, from more holistically from the existing asset stock and those sort of things. What are the sort of things you're employing now on that side of things?
Well, very much on that topic you just talked about. I mean, ESG is central to everything we do. I mean, I came from an ESG background before I came into real estate, where it was very difficult to buy in the idea that ESG needs to be ingrained in businesses. Now it's not just about talking about it, it has to be implemented. It's not a talking shop anymore, absolutely no way. And I can't stress that enough. I mean, a big thing, part of it's driven by legislation. You're not going to be able to avoid that with EPC requirements coming through. You have to be on target for that. A lot of it's driven by stakeholders as well. The pension funds we manage on behalf of, they want ESG targets throughout their mandates. Yeah. And to be quite honest with you, tenants as well, if it makes the running cost of a building more affordable for a tenant, and why wouldn't you go down that route as well? So ESG is a fundamental part in maximising value for future-proofing assets, for longevity of these assets, and making sure that you're not left with stranded assets and having to kind of work backwards from there and being caught out with it. So that is a massive part of it. Obviously, the retrofitting piece, in practice, it sounds great. You retrofit an asset, you turn it back to best in class, but we all know too well build costs are nearly 40% higher than they were at the start of 2020. And so on a pounds and pence basis, it's much higher. On a percentage basis, they have been subsiding, but you look on that period, they're considerably higher. So retrofitting and make it best in class and ESG, in practice, it should work, but when you start looking at the numbers, it quite often might not work. But for us, maximising value is a large part is driven through the ESG requirements and our team that we have specialising that element. And then obviously the portfolio managers, asset managers, fund managers driving the tenant negotiations, etc., to maximise value of portfolios. But for me, it's ESG, to be quite honest.
Yeah, yeah. And Phil, you mentioned a bit earlier about retrofitting and those sort of things. Did you have anything to add to this conversation around the ESG side of things and what you're thinking about with some of your current assets?
Yeah, I think it goes a lot to what sort of both Gillian and David have said. I think, for us, one of our kind of key points of focus when we look at our portfolios across the business, across mandates, is to focus on that operational excellence piece. So that is, boots on the ground. Part of the reason that we have an office up in Manchester and Northwest present is because we have a large asset base up here. So we need to be close to our assets to understand the wants and needs of those assets, but also the wants and needs of our occupiers. Because, fundamentally, if we don't manage and maintain those relationships, then those occupiers could walk away and we may lose that income stream, and it becomes then more challenging to sort of, like you say, retrofit or deal with the challenges as they come along. I think one of the things that we've really focused on, we have clearly a very broad but balanced portfolio. We have some fantastic assets that come with all the green bells and whistles, but we have some complete opposite end of the spectrum assets that come with, the opposite. And I think what's interesting about those is where, there has to be an acceptance that you cannot take a very, very brown asset to a very, very green asset. And the reason I say you cannot do it, physically you can. You can always take an asset from brown to green. But practically, whether or not it's viable from a financial perspective is a completely different sort of discussion. I think also, notwithstanding the fact, is it viable? Will the cap rate improve? Will it be valuable? Will it be more liquid over the long run? Will the rent improve? We have to think about it in the context of our occupiers. Are the rents affordable for that geography? And a lot of the time, we have to accept that delivering a EPC C specification or B specification that might not be absolutely aligned with our wider corporate strategy, is the right strategy in this scenario, because, just wherever these markets are, wherever the assets are located, it won't always have a requirement for the absolute best-in-class products. Mm-hmm. I think the flip side to that, that's probably more focused around industrial. The flip side to that is, we recognise that if we just stand still, then we're going to, have these challenges over the longer run. And I think actually what we are starting to see across our, cross-sector, across mandates, is there is a green premium generally for, ESG sustainable improvements. And I think the way we look at it is, it's the wants and needs of the occupiers clearly, but if we can deliver the ESG initiatives, whether it's the full belt and braces or it's part of the way there, our assets should remain more valuable and more liquid for longer. And I think that's absolutely key from what we're trying to achieve.
Yeah, and I'll get you to in a second, Elizabeth, but maybe Martin, just you got a diversified portfolio there, like the green premium and all that sort of thing. How do you think about that yourselves? And what sort of strategies are you employing around that?
Yeah, so look, really similar to what David and Phil are talking about, right? Yeah. So the aspiration is there, and we want to meet those objectives. We're really behind that. I think the complexity is with our estate as well, you generally layer on some form of operational interface. You talk about construction costs on a constrained site, you know, in central London to move an office asset to an EPCA or B even, and, you know, ultimately you have to achieve then rents that, you know, are unachievable in that space. But for me, I think it's just having that conversation early and embedding it into whatever strategy and long-term plan you take for that asset. And that's the kind of opportunity we have as an organisation, because a lot of these assets we're not going to exit because they're right on top of core stations for us. So it's setting a plan in place to ensure that we aren't caught off guard, and actually we're having the conversations with occupiers, and, you know, we're monitoring where that asset is so that it just doesn't turn out to be stranded at some point in our annual valuation or completely unlettable from a legal position. But I think I'll park that on the sense of our existing estate. You know, we also have a huge development program, and what I'm always really buoyed by is the fact that we do deliver all of that through partnerships. So we've got an office joint venture that we recently set up with Helical. We've done residential developments, a joint venture with Barratt. We've got a large build-to-rent portfolio that we're doing with Granger, and every one of those partners is completely aligned around the ESG aspirations. And I think it's something that has been talked about for a while, but I'm always buoyed and impressed by the fact that, you know, not only the public but the private market really has high aspirations in that space, and whether you can purely recognise the value or not, you know, it is so high on the agenda.
And yeah, over to Elizabeth, maybe a bit on that topic, but also a little bit maybe on the sort of the development pipelines and how you're seeing that sort of thing. And obviously it's early in the supply chain and those sort of things, but yeah, what are you sort of seeing and relating to this?
Yeah, I think it's a really interesting conversation being led here, because clearly we develop a bit like you guys at TfL in your partnerships, and clearly the guys and girls that are funding these opportunities that we are building out, they demand these credentials that so it's not just what are occupiers wanting, it's what investors are wanting too, and what people are expecting. So that's certainly a trend that we're getting on board with more and more, and the ESG side of things is absolutely embedded in our mandate for future projects. I think on the alternative options, you know, it's interesting hearing Schroders and Aberdeen talking about, you know, where they see some of the markets opening up. I think sort of co-living and later living is certainly an area of opportunity to help unlock development pipeline that is being locked by the traditional residential sectors, open market sale, housing association, you know, the various under guises of affordable products. So we're certainly trying to diversify what, you know, we're looking at. It's a new world out there. We're relying on the advice and the information that we're being given, but I think at the moment it's really to diversify. That's what we're sort of challenging ourselves on, because it's all very well looking at a pipeline of development and saying, oh, this is all stuck, but we've got to really try and unlock the value and see the value that we can create in these places and add to the future schemes.
Yep. Excellent. Well, I think, yeah, we're not too far away from questions, so I hope you're writing them down and remembering them. But yeah, so before we jump into some questions from the crowd, I think I wanted to sort of look ahead. We've covered a few topics around, you know, supply chain, obviously, like market environment, things like that. But as we're looking to 2025, we might go left to right across the panel here. Yeah, what are you sort of anticipating as some of our next challenges as we get out of the current environment and into those things? So when you look into 2025 and you're thinking a little bit ahead, where are you sort of focused on in the long term, and what are some of your predictions for next year as we look at that? Starting with you, Phil.
I think for me, with my sort of capital markets kind of transactional hat on, I think one of the challenges that we foresee for the next sort of 12 months, but looking ahead into sort of 2025, is just the transactional markets, in my opinion, at the moment, they remain pretty paralysed to the sort of sizable bid to ask spreads that we see. And I think, you know, it's easy for me to sit here with a buy side hat on and say, look, you know, you're asking too much money for this asset. But I think actually, you know, there is a lot of downstream sort of challenge still to come, I think, amongst particularly our sort of peer group. And I think what that will see is that the market is not necessarily flooded with stock, but certainly over the next 6 months, having had a relatively quiet sort of first half of the year, I expect there to be more activity in the transactional market generally. And, you know, whilst there is definitely a weight of capital there today chasing the absolute best-in-class stock, I do worry a little bit about sort of what is left. You know, what happens to those assets that are arguably obsolete? Is there really a value add play for that type of kit? Or does it just, like you say, fall into the long grass and be forgotten about? And I think at that point, you know, particularly amongst, I'm going to just badge it as regional offices, but particularly regional offices. And I think about this, you know, I sit in Manchester every day and I look around the city, and the number of lights that I see late at night in and around the city are getting not necessarily less and less. Granted, they've gone back up a little bit, but at the start of the year, it was a very, very dark place to be. And it's not that bad, but it was quite a dark place to be. And you do just worry, you know, a lot of investors, I think, are going to look at their office portfolios in particular, and they're going to say, look, it's going to cost me X to, you know, reposition this to attract, you know, strong enough occupational interest to make these works stack up. Or I could look at, you know, repositioning it for alternative uses, or, you know, whatever the strategy might be. And I think it's going to really ask the question of local authorities in terms of what their policies are around alternative uses more generally, but whether or not they go down the route of sort of considering, you know, sustainable sort of sustainable financial backing, whatever you want to call it, whereby actually they will support investors on that journey of sort of repositioning buildings from brown to green, in the hope that they can maintain, I guess, you know, the provision of employment within cities, rather than just letting those employment uses go for, say, residential, which is not a bad thing, by the way, but I think it is definitely going to be a challenge.
Yep. So looking for some support. There are 12,000 people here, so if you're looking for a match, I hope you can find someone to remove the transaction paralysation. But Elizabeth, over to you on looking ahead.
Interestingly, I did write volume of transactions down as my main challenge. I mean, it is a challenge that we're seeing. There's not a lot of comparable evidence out there in the marketplace at the moment, so trying to price things accordingly, you know, the specification that we're offering to the market, it's a challenge because there's nothing really to benchmark ourselves against. We're obviously talking to the points that we talked about earlier with ESG. We're trying to excel. We're trying to do the best product we can, but at the same time, there's a certain price point that we're only ever going to achieve. And yeah, there's nothing really comparable out there. But without, you know, dwelling on that point, I think a couple of the other challenges that I noted down earlier were consumer demands and needs. They're changing. That's a challenge. We've got to be forecasting better. And, you know, that's where a lot of research comes into, and looking at other comparable, you know, developments in other countries and where best practice can be applied here. But consumer demands and needs, that's a really big thing. You know, later living, co-living, they're new sectors for many of us in the UK market. And it's just really understanding where it works, where it doesn't work, and making sure that we're being specific about certain sites and meeting the needs in the local area. And I think really, we haven't really touched on it so much, and it's probably more to Martin, but I think one of the challenges I see is the UK infrastructure and really the immediate pressures that we're facing, in the UK in terms of our infrastructure. You know, I'm blessed to work in London and we've got a great transport network, but that's great down there. It's not so great elsewhere in the UK. And, you know, it's facing into that realisation. We want to grow, we want to succeed, all of us, and we want to develop sustainable neighbourhoods and new town centres, etc. But we've got to have the infrastructure that comes alongside it and the investment in that.
Well, maybe we'll jump over to Martin and come back just to...
I've nothing less to say, but it's time to come back to me.
If you want to go.
No, I'm only joking.
Yeah, well, look, I paid Elizabeth to say good things about our transport in London, so that's thank you. Yeah, I mean, look, we kind of touched on it briefly. I think Phil raised it, but planning obviously is a huge challenge in just getting things delivered through a pipeline and crystallising that pipeline. Because for us, because we work in partnerships in a delivery sense, having that pipeline, being able to structure in a way that is viable and commercial and attractive to the external market, you know, that's our role here, right? So planning makes that very difficult, and equally, you know, the transport interface, of course, it blesses us with a great stock of assets around some great locations, but that comes with engineering challenges, it comes with cost challenges, you know, because invariably we'll be doing some sort of intervention to some kind of step-free access or station entrance or whatever it might be, and, you know, we're responsible to unlock that with our TfL colleagues. So, you know, they are challenges and opportunities at the same time. I think the other piece that I just was going to talk about was, look, our development pipeline, our 20,000 home pipeline, we've set the mandate of delivering 50% affordable housing because And I think Elizabeth started to talk about it. You know, we talk about housing and a housing shortage, but, you know, such a kind of myopic way of looking at it. You're basically looking at one typology, but, you know, later living, student, co-living, affordable housing, whether that's social, intermediate, whatever it might be, you know, there's a huge breadth there and a huge opportunity. But trying to navigate, again, that planning system and the commerciality of it, it's very complicated and challenging, but, you know, we look to work with the best in the business to do that. So we're blessed with that opportunity as well.
Excellent. Well, David, I will come back to you. Lots of specialisation there. And so over to you, like 2025 and some of the things that are ahead of us that maybe haven't been said so far. And poor Elizabeth's going to be last. Sorry, Jill's going to be last.
I think I'd probably just use some of the things that have been talked about in perhaps a different angle. I mean, if you look back for the last 24 months, we've been in an environment where it's all been about central banks. It's been inflation, it's been rates, it's been economic growth.
Mm-hmm.
Now, our sense is that we're kind of at that stage now where the Bank of England are torn whether when that interest rate cutting cycle comes through, and back to Phil's point about the market being relatively turgid, that is largely driven by the interest rate environment we're in right now. And people are kind of almost sitting there on the sidelines thinking, there's going to be a cut coming soon. Maybe don't jump yet. Wait for clear signs, indications that cuts are coming through. Now, we've got inflation out tomorrow. That might give us a bit more weight behind that argument. But that's one thing that's been dominating the market, and there's not as much focus on real estate dynamics.
Mm-hmm.
As we move through the next 6 to 12 months, I do think the market liquidity will start to improve based purely off the fact that a looser monetary policy will mean that actually what you get for your money in other asset classes will be slightly better. I mean, Phil, you can talk to this as well. It's the challenge that we've had, and it will continue to be some sort of a challenge, but probably lesser of a challenge, is that you're competing against other asset classes. You're competing against fixed income. You're competing against equities and multi-asset products. You're even competing against cash when it's at 5.25. But when we start to see rates come off, those products become less appealing. Not completely unappealing, but real estate starts to become more of an even kilter when you start seeing that phase come through. Mm-hmm. And then just lastly on that point, we talked about infrastructure. A big challenge, I think, for real estate will be actually trying to sell itself relative to infrastructure. They're often viewed as two separate products. You invest in infrastructure, you invest in real estate, although they're under the real estate's banner. Actually, they need to go hand in hand, right? If you're making, if you're doing genuine placemaking, you create the product, you create the accommodation, you need the correct infrastructure to support that. So there is a challenge that you might see people more favouring infrastructure, but I think it's a more holistic view you need to take with that, of viewing the two side by side that can work together. And to be honest, I think we've talked about the challenges for so long in the industry that we need to start thinking more about what opportunities come next year, because I do think with that rate cutting environment likely to come through, I do foresee more liquidity coming back. Mm-hmm. For those of us that have got cash, and those funds that are sat on cash, I think there will be some really quite attractively priced opportunities that will come through, and that's what we're obviously laser focused on.
Yep. Very interesting. So, yeah, Jill, do you want to close this out before we open up some questions?
Sure. So everyone's mentioned some great ideas there. I think the one thing to add is power. I think we're noticing a lot in the logistics sector. Power is a real issue. Whether it's just for our straight logistics buildings or for our data centres, that's really holding us back. And I think we all see that we're going to use more power in logistics through automation and also all the EV charging and electric buildings. So that's a real challenge for the future. And I suppose just because we're very much bespoke on logistics and life science, another challenge for us is reserving that land for logistics. You know, I think we all talk about residential, and obviously there's a massive housing need, but in certain areas we've seen massive reduction of that space. So Park Royal, which is the prime, we call it the breadbasket of London, of industrial location, has shrunk to a third of what it was. So if you're creating 100 new post boxes, you need to have those serviced by logistics. So it's very much having that infrastructure. I know we've talked about other sorts of infrastructure in this chat. It's creating that infrastructure for logistics and designing those into those residential schemes, reserving that land in cities for those uses.
and then designing what we're doing now, which is multi-level and high-density schemes.
Excellent. All right, so I'm going to throw it over to the crowd now. Is there anyone got any questions that they wanted to ask this audience? I think we've got a microphone up the back, so yeah, there's one there.
Hello, Simon Keane from Burkitt's. Firstly, thank you to the panel. Really interesting insights, some fascinating opinions there. I was particularly interested to hear about the sort of importance you're all placing on ESG. And I wondered if you could comment, please, on the social value side of that and how you're integrating that into your assets and the occupier response to it, please.
Thanks, Simon. Who wants to take the first shot here?
I can take it if you want.
Yep.
I mean, it's a great question because everyone talks about ESG, but in reality, for real estate, the easiest thing to monitor is the E part of ESG. You can put photovoltaics on, you can use water recycling on units, etc. The S bit is very difficult to capture and actually quantify, and I think that's what people are still really trying to get their head around, is to quantify a number associated with those three components. If I put my hat on back to my previous role as an ESG analyst, we covered equities and fixed income, and that was an issue then because there are certain industries that worked in areas of the market where it was much easier to quantify the S, and I think we're, as an industry, need to get better at it. Clearly, there are elements of real estate which is much easier to quantify. And back to the talk, we're talking about residential, for example. You talk about affordable accommodation or discounted market rents, for example, or even placemaking and amenity provision within residential units that you have, which is easier to quantify the social element. When you start moving into your pure play standard commercial segments of offices and industrial, it's not quite as simple. I'm not saying anyone has the answer. I think it's an evolution for that piece because the E part is very much has been focused, and people are now really starting to focus on how do we do the S part. And also, there's elements of the E that stray into the S. Biodiversity, for example. The two are interlinked, and we do a lot of work on that to make sure that, you can often put them in isolated buckets, but they should really interact with each other a bit more, the E and the S particularly. So that's, that would be my take on it. I'm happy to open up.
Yeah, just to add, because I suppose very much specific on the industrial sector, we've got a scheme up in Daventry International Freight Rail Terminal. It's the only rail terminal with industrial around it in the UK. We've put in a hub building, and our hub has a training program, so we train people in logistics. So we've got a huge amount of millions of pounds worth of social value in that hub. We train people who are unemployed or who've come out of prison or who are on the county lines, trying to get them into logistics. And we're trying to encourage, 7% of the UK are in logistics, trying to increase that and make it more attractive to young people. So we've taken schools, very much having to educate the teachers first so they can educate the children, and trying to increase that awareness. And I think we've noticed that the under 35s are much more positive about opportunities in infrastructure and in logistics because of all the computers and the wide range of jobs and the opportunities they bring.
Yeah, Martin?
Yeah, no. Look, it's a great question because we all talk about the E, don't we? And spend a lot of time doing that because it's, I think, like David says, it's easier to measure, right? You can set some clear parameters around it. And the social side for us is absolutely baked in our DNA. I was talking about 98% of SMEs that sit across our estate, 50% affordable housing that we're doing. It is about value to a city and to a country, not just simply a financial or environmental benefit. And I just sort of caught the eye of my CFO. I just saw him at the back. So I have the easy job of writing the investment strategy. He has the hard job of sitting on our investment committee and defining, where we actually deploy that capital. And I'm a strong believer in simplicity. So we're working on our social impact framework at the moment, which is how we make judgment calls around the social value that we bring. And you can delve into rabbit holes left, right, and centre, trying to put numbers next to it or trying to somehow rank it. But actually, when you take a step back, the simplicity of that, transport improvements, financial, environmental, it's about having a layer and an approach to kind of answer that and keep in line with the overall strategic direction of your business, which for us can be complicated at times, but it's incredibly exciting.
Excellent. Do we have any other questions in the audience? While people are thinking, was there anything you wanted to add to the last topic on this side of the table?
I guess just really touching on what Martin said there, I think, you know, we can all sit and this is criticising ourselves as well, but you can sit and judge your development or your scheme or your asset alone. But I think social value and social impact, it's about the macro, it's about the area that you're working in, and that's the sort of real impact that I think that we're all going to make. We're not going to make it in the single building that we all own and manage. I think it's something where we need to act collaboratively, you know, with the likes of TfL or the likes of, you know, your local authority or the GLA or whoever it may be, or the Metropolitan Mayor of Manchester as an example, you know, to really make sure that the social value you're making on your scheme actually collaborates with all the other social value in the area, because otherwise really it doesn't really make sense, because we can all measure it and give pounds and pence to colleges and technical colleges, etc., but you know, at the end of the day we need to make sure that we're making that real impact at a macro level.
Yeah, I would agree with that. Look, I think one of the things that probably in the real estate industry we've been culprits of in the past has been quite inward focused on projects. You know, we call them regen projects or whatever it might be, but we look inwardly into the site we're operating in. You know, a big thing for us is an organisation that has a significant amount of land that works in partnership. It's not just partnership with the people we're delivering with, the local community, right? So trying to blur, I mean, it's a trite phrase now, but blur the red line around the edge of the site and say, well, look, how does this actually interface with the community? Because if, take the long term that we do, if we don't bake that into our designs at the start, you know, we're doomed to fail in 5 or 10 years, and you know, that's not where we want to be. So yeah, I completely echo what others were saying there.
Yep. Excellent. Do we have any more questions? Yep. One of the front here first.
Hi. Firstly, many thanks for your sort of discussion points. It's quite interesting to hear the differences between E, the S, and the G side of things on things. So I'm Adrian Lim from Quartz British Services. Just got a question around trying to blur those lines around infrastructure, E and S. Obviously, as a country, we've massively underinvested in infrastructure, be that hospitals, education, roads, transport nodes, etc. At what point does the panel think that perhaps repurposing underclass assets such as retail, shopping centres, or otherwise alongside hospitals and other things could be done, but equally maybe looking at some of the smaller class uses, regional offices or otherwise, into more purposeful assets, maybe taking some of the smaller pockets of equity and capital and using those as your ticket to entry. Does it feel like there's either an asset is too small or too big as fund owners and developers? Just be keen to hear your thoughts on that.
Phil, do you want to take first?
Yeah, I'll take it.
Yeah.
I think first, it's a great question, and it's definitely, I'm sure I can sort of comment on behalf of everyone, it's definitely sort of at the pivotal point of focus in terms of what we're trying to do from a sort of core real estate perspective on a regular basis. I think at the moment there is definitely still a lack of understanding in terms of what the strategy needs to look like to get to the answer, and that's because we're all learning about it on a, you know, the more we understand it, the better we'll get at doing it. But I think we are still at that sort of forefront in terms of our understanding. And I think actually what I didn't say but is critical, and it kind of goes to that sort of collaborative approach, is it's absolutely imperative that we deal with this issue holistically. So it's not just us as fund managers, investment managers, it's also all of our consultants, it's all of our suppliers, it is literally everybody across the board. We are all responsible for it. And I think to go to the sort of the point of the question, which is, you know, to what extent are we now looking to repurpose perhaps buildings to introduce perhaps sort of service provisions that maybe don't exist, but that would have that positive social impact? Absolutely, we're looking at doing it. But it has to be in the context of the wants and needs of that particular location at the point in time. So I think, you know, just for a bit more context, we at Schroders, and I'm sure a number of other houses now also have it, but we have a UK Impact Fund. I'm not the UK Impact Fund manager. He is here at somewhere today, so I will introduce you if you want to meet him. But you know, a lot of the strategies that we are now looking at for that Impact Fund, they are focused around, you know, delivering, yes, a degree of return for our investors, but it is also matching the sort of ESG criteria of those investors. And I think what has been quite interesting from sort of my perspective in particular to see is that those investors are happy to take a diluted return to deliver that positive social impact. And I think that's the critical bit. And I think as we look at our investment base across portfolios, we'll see a number of investors look to diversify their portfolios to include an element of exposure to those, impact-related strategies. And I think, just to sort of sign off, we'll end up doing it. It's just sort of when and where.
Yeah, I mean, I could add a little bit to that and echo your views and thoughts on that. I mean, the one thing I kind of look back on an ethical perspective from equity funds, you quite often get ethical exclusion funds, right? So investors say, I don't want to invest in those names, and they're willing to take perhaps not quite as big returns as they could do in other funds because of that ethical element. Now, that's not necessarily always the case, but I think to your point on the impact funds, you've got to realise that repurposing some of these assets just don't work financially. So the returns have got to work for the investor as well, and it might not necessarily work in some of the funds that you have for certain clients, and there has to be a strategy that works, but it comes down to the appetite for risk, for returns for the client as well, and that trade-off, I guess, at the moment, which is challenging because of those build cost elements and the cost of construction to make it work. And I suppose the final element is not all buildings physically can be repurposed into other use classes, which is, it would be great if they could, but looking at older office stock, floor depths, for example, do you knock it down and go back to the start? Well, from a net zero perspective, that's not really ideal. So there's hurdles along the way. I think we'll get there as an industry, absolutely. It may take new products to do that, but I think we will get there. It's just going to take time to figure out how we actually get to that end goal, I think.
All right, we should have time for a couple more questions. Is there another question in the third row there, or yep? Was it? Yep.
Hello, my name's Arlo Mills from Evaluation Consultants. Just picking up that conversation about social responsibility. Obviously, there's a question about the investment value, but surely in terms of when you're talking about infrastructure, and particularly homes and that sort of thing, there's a lot of density of housing. Surely there's got to be responsibility in terms of looking at public services. I'm talking about hospitals, schools, GP practices. There's a lot of pressure on those services when there's more housing being built in localities that are not being serviced effectively, which I imagine is going to be a kind of particularly schools. For certain people want to be in an area where there's good schools. If there aren't those facilities there, they might not move into those areas and developments you're proposing. So how do you do that and liaise with local authorities to make sure that happens? There's kind of integrated infrastructure and public services.
I mean, I'm happy to kick off here. I think, again, it's just collaboration. We don't want to work in silos. Obviously, a lot of us here around around this board, we all work on big projects, but I think it's really working within the realms of the local authorities and public sector bodies that you're within. Like, for example, I've heard of basically it's like mapping of community needs for the next 10, 15 years. And that, I think, obviously, we can all push back and rely on the local authority to do that. Whilst they've got a responsibility, statutory responsibility within their, within their roles, we've got to do it as well. If we're to build places that we're proud of in 10, 15, 20 years, it's proud to come back to, yes, you're right, we can't just build 200 homes and expect people to move in and not have an impact on the local NHS services. Of course, it's working with the local developers and the local authorities. I don't think any one of us is going to be the answer, but I think it's just a collaboration as always.
I think I would agree with that entirely. I mean, one of our sort of core strategies for the impact fund in particular is around delivering residential, new homes in very, very deprived parts of the country. And I think what we use is a very sort of proprietary impact framework, scorecard, whatever you want to call it. And actually that will tell you that, where the challenges are, and typically where there is a lack of affordable housing and a requirement for it, you will also get the same correlation between the lack of service provision. So actually when we're looking at these schemes and what we can deliver in terms of, the geographies where the demand is, it isn't just a single sort of asset class. It is much more broad than that, and it is capturing the requirement for that sort of mixed use provision and that additional service provision, whether that be additional GP surgeries, what the wants and needs are there, but also, additional educational facilities. It's absolutely on the radar.
Excellent. We probably have time for one more question, I'd say. So is there, maybe, yeah. It depends how quick it is. We might get to, yep.
Borders Coast. I just wondered what excites you going forward. Are there any particular sort of sectors or regions within the UK that you're really excited about going forward?
All right, this is a good way to finish the panel, I think. So let's go left to right, maybe, and just say what excites you, and a bit short and sharp.
Look, I think just real estate generally. I think if you're well capitalised, like thankfully we are at the moment, there's really attractively priced opportunities in high growth locations that present anything from sort of value add opportunities where we can take browner assets and reposition them and deliver them to a market that has real demands for a green product. To much shinier real estate that is just now repriced.
Certainly, from my perspective, I think what's exciting is the fact that there is still demand. There is still demand out there for good quality housing and good quality office space. We've got to pitch it at the right place and we've got to pitch it to the right market. But, it's what gets us out of bed in the morning, I think, is the fact that we're out there doing this and building homes and space for people to live in and operate in and have a healthy place to live and work.
I'm going to be really geeky and just talk about actually the possibilities for investment in terms of sectors in the UK. So back to my earlier point, when you talk about building a diversified portfolio 10 years ago, it was quite standard what you would go in there. Now the breadth of opportunity in the UK and what you can invest in a portfolio is vast compared to where we were 10 years ago. And actually in some aspects it mirrors more the US than it has done historically. PBSA, build to rent, healthcare assets. We're now seeing data centres come in. So it's that breadth of possibility investing across the spectrum in UK real estate to build future-proof portfolios. That's the exciting thing for me. We're not limited by a handful of sectors to invest in.
For me, it's all about innovation and AI. I think we've got to all move forward. I know that there's a lot of fear. People feel their jobs are being made redundant, but I think that's not going to be the case. People are just going to be trained in different sectors, and I think with AI is going to mean that we'll be more efficient, safer, and more profitable.
Yeah, look, I mean, what's amazed me about this chat and the questions today is spend so much time talking about ESG and all the good stuff that comes with that. So for me, what I'm excited about is just the opportunity to work with partners across the industry, private and public, right? There's just huge opportunities in that space, which is brilliant. But I suppose, look, I'm pretty excited actually that I've got through my first UKREIIF panel actually, so I'm just going to leave it there maybe.
Yeah, well, you got almost 2.5 days left, so keep the energy. But some great topics up here. Thank you for being a great crowd. But sector specialisation, lots of new opportunities across the board. ESG a big topic, the green premium, working in collaboration with the infrastructure and planning side of things. But most importantly, there's some active investors on this panel. So let's start talking. Let's talk about a bit of work in the market, and there's 12,000 people here, so some transactions would be nice. And thank you very much for being such a dynamic panel.
Thank you.